Assalamualaikum friends, welcome to question number 15, traveler. Okay, so you can see you have been given the financial statements or financial position of the three companies. Definitely the travel is the parent and data and captive both might be subsidiary, or one is subsidiary, one is associate. We'll see. So these are the following information which is relevant for the preparation of group financial statements. Okay, let's see how many points we have. 1, 2, 3. Okay, and part A is prepare a consolidated statement of financial position. Okay, so this is a unique type of question because from question 1 to 14, if you have gone through 1 to 14, we were doing all group accounting, we were making goodwill and CI, all those things we were calculating. But this is a question where we have to prepare a full consolidated statement of financial position. Before this, we have not been asked from question 1 to 14. Okay, so this is a very good question to end your group accounting questions, because only this question and the next question number 16, are relating to group accounting. From question 17 onwards, we'll be doing ethical questions. Okay, so you have to prepare consolidated for the group for the year ended. Okay, and it's for 23 marks. It's very important that you know how these marks are divided across the sections. Coming to part B, for part B we have a separate case study where it is for 7 marks. Discuss whether traveler's proposal is in accordance with IFRS standard. Okay, so we'll read it later. Let us first finish part A. So let us read the information. Traveler acquires 60% of equity interest of data. Data and captive. Okay. Acquires 60% of data. So it's a subsidiary. Okay. For how much? For 600 million. What is the fair value of NCI? Fair value of NCI is 395. Okay. Wish to use full goodwill method. The fair value of net asset is 935 million, and retained earnings is 299 million, and other components is 26 million. Excess is due to non-depreciable land, excess in fair value. Traveler acquired 20% interest in data for a cap. Another 24%, 20%. That means you see, he directly didn't get in one go only 80%. First he got 60%, then he bought another 20%. So if you see, he is still a subsidiary. Even after further accusation, he is still a subsidiary only. Okay, sometimes what happens when you purchase, you can dispose of, or you purchase again, you purchase. So it's known as step accusation. Okay, for how much? For 220 million you purchased. Okay, now if you see, did you notice one thing? That I finished reading point number 1, I think less than a minute. How come? How come that I finished so fast? Practice. Because I've been practicing all these questions from 1 to 14. All these days I've been practicing this with you. So now my subconscious mind knows, okay, that when they have acquired, first line is accusation. Second, they will give you the cash consideration. Third, they will give you the NCI value. Then they will give you the net asset value. Then they will tell you the excess in fair value. Then they will tell you goodwill is measured at full goodwill or proportionate share. You see, they follow an order. Every question has this order only. So I could pick up the things. Even if I didn't read the full sentence, I could pick up the things. What is the next line? This is why practice helps. If you see my first few videos, go back and check now. I was very slow. I was reading one by one and it was taking so much of time. This one I just finished less than a minute. Okay. So that's why practice is required for you to catch up that speed. Okay. Now let us go to point number 2. 1st of December 2000, he acquired 80%, again a subsidiary, at captive. For how much? 541 million. The consideration compromise cash and transfer of non-depreciable land with a fair value of 64 million. Remember this. This 541 million is broken down into cash 477 and land with a fair value of 64 million. Okay, land we anyway don't depreciate, so it's non-depreciable land with a fair value of 64 million. That means we are giving a cash also and land also to get captive. That could happen, okay, because consideration you can give in any form. We'll see how to work out in this. This is a new thing under consideration. Now So the carrying amount of land at acquisition date is 56 million. Definitely at the acquisition date you want to know what is the carrying amount. Okay, at the year end this asset is still there in the non-current assets and sale process have been credited to P&L. This asset is still included in the non-current asset, but the sale proceeds have been credited to P&L. Now, at the date of acquisition, net asset had a fair value. So, net asset 526 million, retained earnings 90 million, other components of equity 24 million, excess in fair value is due to land. This acquisition was accounted using partial goodwill method. So the way first company data was calculated using full goodwill method, this one is calculated using partial goodwill method. This is a very good question because it will teach you both this thing in one question only. Both the way of calculating goodwill in accordance with IFRS 3. Okay. Third, goodwill was impaired test of the additional acquisition and data on 30th. So after it was goodwill is impaired when not at initial. After you bought the additional acquisition in data, the first company, from when you went from 60 to 20. Okay. That time goodwill was impaired. And the recoverable amount. So because impairment is there, they will give you the recoverable amount. Carrying amount you have to calculate. Okay. So the recoverable amount, one for the net asset, one for the goodwill. Okay. Net asset and goodwill of data is this one and that of captive. For captive it is 700 million. Okay. For net assets and goodwill of data is 1099 million recoverable amount. Prepare consolidated financial statements. How do you start? You start by working one. Okay. You start by this. Leave space, one or two pages, and then go to working and do the group structure number one. First you start doing the group structure. When there are more than one company, and when you are buying and selling in step acquisition is there, this is a very good method to do. Okay. So travel is the parent company. Okay. P, this is a subsidiary, this is also a subsidiary. First we'll go by data because that is the first company. Okay. So write the date on 1st of December till 30th November 60%. After that it's 80%. Okay. Then here it is directly 80% only. Okay. In the name of the company. Second, what is second? So all the things what you need at the acquisition to write on the consolidated statement of financial position, we'll go through the workings. Okay. Working to is net asset. We need net asset, isn't it, to calculate goodwill and all. Okay. Net asset should be at fair value. Okay. So here, this is a pro forma. I'm putting a star mark so that you memorize this. Whenever you have to calculate net asset, okay, learn this pro forma, it will help you. Okay, this is the way. You start with share capital, retained earnings, other components of equity. If it's given, if it's not given, then no need to write it. But in this question is given, so other components of equity also will come. And at the end, the balance is the fair value adjustment. You see, fair value adjustment is for the land is the balance figure because you will definitely be given the closing and the opening balance. Okay. So you have been given this acquisition date. You have been given 935 net asset. Okay. This one is given. This one, where will you find it out? From your statement of financial position. You need to go here. All these things you will put. Okay. Of whom? Of this person. 600 will go. 442 will go. 37 will go. These are at the reporting date. Okay. This three. And when you want to find for the acquisition date, you have to go to the first information. Okay. Here you have been given the, just wait a minute. You see 1079. This is the net asset at the reporting date. At acquisition date, the net asset is 930. Let me highlight it. 935 million. Okay. And this is the retained earnings. This is the component. Okay. Share capital will remain the same, whether acquisition, whether reporting date. Whenever they say at reporting date, you have to use the statement of financial position to get the figure. Okay. The subsidiaries, not the parents. Now you didn't consolidate yet. You are only finding the net asset of the subsidiary of data. That's why you are only using data's share capital, return earnings, other components of equity, and their land. Okay. So the balance is land. Now we'll go here. You see, this remains same. This will change. This will change. This will change. This is also same because there's no value adjustment in the reporting date. Okay, whatever is at the acquisition date, you will take in the reporting date. Okay, this and this will be same, 10 and 10. 10 how? Because the balancing. This is given to you. So add all this minus 935, balance is 10. That 10 only will go. Okay, when you add that 10, okay, you can see that it's 1089. I'm sorry, reporting date net asset you don't take here. Okay, that was 1079. Here is 1089 because of this 10 fair value adjustment. You, how do you take this 10 here? You take from this side. Okay, the first column. If you take 10, then you take it here and post it here. Okay, that's how, then you add, and that's how you are getting 1089, the net asset at reporting date. Okay, when you do this, the net asset is the increase amount. Okay, so the net asset is how much? This minus this, which is 154 million. Okay, out of that, 11 relates to other components of equity and 143 relates to return on. Just see the increase, how much it has increased. Okay, from 442 to 299, from 3726. Just deduct the difference, you will find out. Okay, same while we are doing for data, write the name of the company like this, because you have to do for the two companies. Write for captive also like that. Okay, captive also you have to do same way. From this is from statement of financial, sorry, this is from statement of financial position you are taking. So share capital will remain as it is. I don't know why. What's okay? Share capital will remain as it is, 390 390. Then this is given to you, and this is also from the reporting. So this is also given to you, and this is also given to you. Okay, here also the balance is the fair value adjustment, same like before. Okay, no difference. So here also this is the net. The net asset is this. Okay, out of this 21 goes to other components and 79 goes to retained earnings. Same way how we have done for that, and there's no difference. Third is goodwill. Okay, we calculate goodwill because what do we need for goodwill? We have been given the net asset acquired. We have just found out. You see, if you see, there's a logic behind the number of working you are doing. Your first working is net asset, not goodwill, because you need net asset for the goodwill. You see, for goodwill you need three things: NCI, the consideration, purchase price, and the net asset. Purchase price and NCI is already given to you. Only working is required is net asset. Okay, so after working two, we are going to the goodwill. Okay, we calculate goodwill when we first acquired. Remember, not when we took the additional 20%. Why? Because from 60 to, it's still a subsidiary. From 60 to 20, you don't calculate goodwill twice. Only first initially when you acquired and you gain the control 60%, that time you are calculating goodwill. Okay, so fair value of consideration 600, we have already underlined. Okay, fair value of NCI is already given. This we have worked out 935. Which net asset are you taking? Net assets acquired 935. This one you are taking, not at the reporting date, not 1089, at acquisition date you are taking. Always take the acquisition date net asset. Okay, so you minus, you get goodwill, and we have been told that goodwill has been impaired. Okay, so the impairment working is in 650, and then goodwill at the reporting date is 10. Before we go to the impairment of goodwill impairment, let us do for captive also the same thing. Fair value has been given 541. Okay, when you are taking the the consideration, remember there were two. One we are giving land, the other one we are giving cash. The total amount only you have to take. Okay, 541. We have been given separately. 477 is for cash and the balance 54 is for land. Together only you are taking it. Okay, 541. NCI at acquisition. Here NCI you have to calculate partial goodwill. That means fair value of NCI is not given. 20% of the net asset. Net asset working 2. We have already calculated this. 526, this one, as I told you, this one, okay? At the acquisition date net asset you have to take, not the reporting date net asset. So that you are taking 20% because 80% you have got of captive. So NCI will be 20% on that, which is this. And then minus the net asset goodwill. Here also impairment is there, which is done under working 6. Okay. So this is the thing which you need to learn. Presentation of your answer matters a lot. See how they have presented. They didn't do two separate working for both the companies. Under one working only, they did for both the companies. This saves time. So you also adopt this technique. For example, goodwill when they calculated under working 2, working 3, both for both the companies they calculated. Same for the net asset. So it saves time. Okay, you always have to think in the exam also when you are giving, while you are practicing also. You always have to think of ways of minimizing time so that you can do the fastest. You're working fast as you can do. You have to think ways like that. You have to be creative there. Okay. So impairment will go later. Okay. So this is 59. So now when you take the total goodwill, you add both because both are subsidiary. You can consolidate together. No need to show separately. In the consolidated statement of financial position, you will only show one goodwill figure. You will not say goodwill for this, goodwill for that. No. Okay. Now remember, there is a part relating to land building, right? When the consideration you gave as a land building, we have to take care of this. Under this working only we have to do it. Okay, because consideration we included here 541. So what are we going to do with the that? So the asset transferred as a part of the consideration needs to be removed from the non-current asset. We transfer the asset, so remove it from the non-current asset. From the building you need to remove it because we transferred that as a part of a consideration, right? And gain on the disposal needs to be calculated. So when we make a disposal, there might be a gain, so that needs to be calculated. The sale consideration 64 has been recorded in profit, right? So the carrying amount of the asset is 56 million, correct? So the difference is the gain on disposal, which is 8 million. The adjustment needs to be arrived at the gain. So this is the adjustment which you need to do. Okay, 64. We'll again go back and check this because I kind of forgot the figure. It is for the second company. It is under point 2. Okay, they have told. So land had a fair value. This is 64. You have transferred 64. That means you are selling 64. And how much you have recorded? The sale proceeds you have recorded 64. You have recorded, right? And carrying amount at the acquisition date was 56. So the balance is the profit 8. So that 8 is a gain. How do you write that gain? You credit PPE because you are carrying amount. That carrying amount needs to be credited. You are eliminating it from the property, plant and equipment. So you might deduct. That's why credit PPE 56 million, the carrying amount. And debit where? Retained earnings. You need to debit in the retained earnings. This will go under working 5. There is no separate working, but this will go in the retained earnings working 5 because when you are doing retained earnings, working 5 is retained earnings. There you have to take this. There you have to minus this 56. Okay. And then PPE also, when you are doing property, plant and equipment working, you have to minus this 56. Okay. Because in the profit and loss account, you recorded 64. So now you need to minus 56 from there. You need to deduct 56. That's why you're debiting retained earnings. Because before 64 was credited in profit and loss account. Now you debit 56, so it becomes 8. You see, that's how you are going to get 8 as a gain. That line is there, right? That it has been credited and all. It is this one. Okay, you see Sale proceed had been credited to P&L. That's why you need to debit now. So it will go down. Return earnings, that's why return earnings are debited. What is the sale proceed? 64. 64, right? So that's why you're debiting 56 to get the 8 as a gain. Now NCI. Okay. For NCI, we need impairment of goodwill. Okay. So before NCI, we need to do other workings. Reserves also requires other workings. You see NCI working for NCI will, and then comes reserve. So follow this order. If you see the working, I'm scrolling down to show you. First, you start with this one, group structure. Number one. Second, net asset. Third is goodwill. Okay. This order is almost followed in all the questions. Third is goodwill, working 3. Working 4 is NCI. After goodwill is NCI. Then we have reserves. Okay. Then we have other components of equity. Then we have impairment of goodwill. Okay. After impairment of goodwill, we have increase in shareholding. Remember, from 60 to 20. So that increase needs to be shown. Because of that, NCI is increasing. Okay. Working 7. Then we have working 8, property, plant and equipment. Usually property, plant and equipment, if you have one asset, that asset is usually shown as the last working, but you can write it before, it does not matter. Any order you can write it. Okay. So there are total 8 workings, as you can see. Now we are going to go through the impairment of goodwill so that we are done with the, because for this we don't need any other workings. Okay. So now what do you do? Goodwill from working 3 you can get. Okay. So goodwill you have this is for data. Okay. Please write the name of the company. So for data, goodwill is 60. Okay. Then we have identifiable net assets. Identifiable net assets, which identifiable net assets are you taking? Not at the accusation date. Not at the accusation date. You have to take at the reporting date. This is why you need to practice. You should know when to take at accusation, when to take at reporting date. This, if you see the figure, if you see this is 1089. It is at the reporting date, net asset, not at the accusation date. Okay. So that plus the goodwill total, and this total you compare with the recoverable amount. Recoverable amount has been given to you for data. So therefore goodwill impairment is 50. Okay. So this is how you got the goodwill for data. Now this is a full goodwill method, right? So since it's a full goodwill method, you need to split it between the parent and the NCI. Always goodwill has to be split between the parent and the NCI. Okay, 80-20. 80% you have to take, not at the 60%. It is true that when you are calculating goodwill, you are calculating when it was 60%. But when you split, you have to split it 80-20. Because even if you bought 80%, you are still a subsidiary. Okay. So goodwill impairment relating to data will be split at which ratio? 80-20 between the group and the NCI. The retained earnings will be debited with a 40 million and 10 million working for. Retained earnings will be debited with a 40 million for working 5 is there in NCI 10 million. This you will understand when we go through NCI. Okay, or retained earnings. Definitely goodwill impairment will go in the profit and loss account. So because of that your earnings will go down. That's why retained earnings will be debited. Okay, 40 million. Out of this 40, okay, 50, sorry, 40 goes to parent, 10 goes to NCI. Okay, just take 80% of 50, which is 40. So if 40 goes to parent, that as an impairment that will be debited. Okay, it will be debited in the retained earnings. And from NCI 10, this 10 you are not taking. Remember, this whole 50 you are not taking and minusing it from retained earnings. Only the parent's portion you are taking. The NCI portion will go in the NCI part. Okay, let's see what the tutorial note says. It could be argued that 60-40 allocation between group and NCI is also appropriate, as this is way how profits that arose in the year have been apportioned, and the impairment is a loss that arose in the year, albeit calculated at the year end. Okay, we assume that it was calculated at the year end. That's why we at the year end it was 80-20. Okay, but some could say that why now 60-40? but we'll just go by the marking scheme, what they have given. It's more safe to go by what they have given rather than you taking 60/40 and then messing up. Okay. Now let us go for captive and do the goodwill impairment too. So goodwill we have already calculated under working 3 for captive. Next we have, remember, for captive the goodwill was partial goodwill. So for partial goodwill you have, don't forget to cross up the goodwill. Okay. That is known as notional NCI, you can say, or notional goodwill. How do you take the NCI? Definitely with the goodwill you need to add the notional NCI. The NCI portion you have to add with the goodwill. When it's a partial goodwill method, this is the way to calculate. Okay. With goodwill you add the notional NCI. How do you take notional NCI? It is this 120, which is this. Okay. This goodwill, on that you are taking 20 divided by 80. This is most important, the fraction. How do you get the fraction? Most of people take 20 over 100. Don't take 20%. When you're grossing it up, it's 20 over 80. Okay. If you are taking 20 over 100, it means you are taking 20% of 120.2. No, that's not what it is. Okay. You need to take out of 120.2. What is the proportion for the NCI? That you need to remove it from that. That's why we are taking 20 over 80, because NCI is 20% over 80. Okay. If NCI was, let's say, 30%, then it would be 30 over 70. It goes like that. Your this and this should add up to 100. Okay. So just remember this portion. That's NCI, right? 30%. You will be taking. So it's like this. Let me show you. If it's a NCI, let's say it's 30%. So it will be, okay, NCI is 30%. It will be 30 over 100 minus 30. This is the formula for grossing up. Remember this. Keep it somewhere. 100 minus that percentage, whatever the NCI is percentage. Okay. So it's 20 over 80. And 30. You add it, you will get the total notional goodwill. From that, net assets we have already identified. Okay. Which net asset are you taking? At the not at the reporting date, at the accusation date. Adding both, you will get the total. Recoverable amount has already been given to you. Total is greater than recoverable amount. Impairment is this one. This is the impairment. Okay. So when we go to the goodwill above, working number 3, you see, this is the impairment. This was the impairment. 50, which we got. And for captive, just now we got 61. 61 as an impairment. Here you are taking the full goodwill, by the way, because this is full goodwill method. Okay. Here you have to gross up and then take. When you are taking goodwill here, you are taking 60 minus 50, not 40 and 10. That 40 and 10 comes in the retained earnings when you are taking. $61. Let us go through that again. 60. Yes, 76.3 is whole amount, but we read this line. How 61? Okay. The impairment is allocated to notional goodwill. However, only 80% of the notional goodwill has been recognized in the consolidated statement, and only 80% of the impairment is accounted. Only 80% of the impairment is going for. This is when partial goodwill is there. Okay. So the goodwill impaired is, you have to take 80% of 76.3. Only 61 will go. So this expense is uh, attributed to the group, and retained earnings must be debited with 61. Okay. So we are done with it. Now, what should we go through? We should go through NCI. But remember, in NCI, one thing is there needed. It is this working 7, which is reduction in NCI. How much your NCI increase? Whenever you purchase additional shares, NCI will reduce. That reduction you need to calculate. You need to deduct that reduction. from NCI. So first we'll go through working 7 and calculate that, and then we'll come to NCI. Okay. It is this increase in shareholding. Okay, it's under this one. So we'll see. This is the pro forma, which again you can use when it's an increase in shareholding. Okay, you can memorize this and keep the pattern. First we start with the fair value of consideration. Okay, this is for whom? This is only for data. That's why they didn't divide the two companies. Okay, because for captive it's only once 80% we have to get. So only for data. So data fair value of consideration has been given 220. This 220, which consideration are you using? Not when you have initially purchased 60%. When you have purchased the additional 20%, that purchase consideration only you are taking. Okay, 220. NCI in data at acquisition working for. Okay, what is the NCI at acquisition? 395. Working for. We have to go to working for and see. 395, and this NCI comes from working 3. 395. Again, we'll go to working 3. It's given actually. 395. You see, fair value of NCI. It's already given in the question. So that 395 only you are taking. Okay, where is it? Okay, so NCI when you are taking at the date of acquisition. Date of acquisition means when you have first purchased the 60%, that time NCI figure was given to you. That NCI you are taking. Okay, next NCI percentage of data net assets movement. What is the net asset movement? NCI percentage. You have to take the NCI percentage of the net asset movement in working for. You don't have to go to working for. We know what is the net asset movement. Okay, we'll see. Go to working for and see. Okay, so this is the net asset movement 154. You are taking 40% on it. Why 40%? When you had 60% initially, NCI was 40%. You are taking that 40%. Don't take 20%. We'll come to that additional 20% later. But first, at acquisition 154. Working 2, when we took net asset, forget about captive data. How much was the net asset movement? This 154 million. On this only you will take the net NCI percentage 154. So when you are taking 40% on 154, it is 61 point. It is 61.6. This one. So you are taking basically 40% on 154. That's why you are getting 61.6%. Okay. That means beginning NCI when you have purchased the first 60% plus 40% of net assets when you have first acquired. Add both. Okay. So this is the NCI per share purchase. After that, what do you do? What do you do? You write this line. Reduction in NCI. What is the reduction in NCI? So this is the first line. Second is NCI data at acquisition. Third is the NCI percentage of net assets. Fourth is the NCI per share purchase. You add basically, you add 2 and 3. Okay, so 4 is like 2 plus 3. Then this is 5 and then this is 6. The 6 items needs to be there. 5 is reduction in CA. Sometimes it could be increase in CA also. Okay, NCI also. When it's an increase, that time also you have to find out. When it's a reduction, that time also you have to find out. Reduction in NCI, sorry, increase in NCI comes when you dispose. Okay, let's say you have disposed, you were 80% before, now you have disposed 20% from 80 to 60%, you have become 80 to 60%. So your NCI will increase by 20%. That increase also you need to find out. When it's a reduction in this case also you need to find out. Both the conditions you need to find out. This additional working is required. Okay, increase or decrease in shareholding. So how much you reduced? How much you have purchased? 20%, right? How much NCI you had before? So it's like new NCI divided by old NCI. This is the formula. Okay, new NCI divided by old NCI. New NCI is 20%, old NCI is 40%, 20 over 40 into this amount. NCI per share purchase. Then you will get this figure. So this, you take this difference, how much it has increased. Before it was 220, now it has increased to 228.3. So the increase, it's a positive movement in equity, it will go to equity, 8.3. Okay. So your NCI reduced by 2 to 8.3. Now we can go to working for and complete our NCI working. Okay. So how do we start NCI? We always start with the date at acquisition. Acquisition initially when we bought the 60%, that time NCI was given fair value 395. Next, we add the percentage of data's post acquisition net assets, which was 154. We calculated the net asset movement in working to, you take 40% because initially NCI was 40%, you added reduction in NCI. We went to the working 7, we got this reduction, not that 8.3. that difference 8.3 is in, will go in equity. Okay, so 2 to 8.3. Impairment of data goodwill, remember 40 and 10, that 10 will go to NCI. Okay, it's an impairment, so that impairment, it's a reduction again. Next we have NCI in captive. Remember NCI will include both the company, data plus captive. That's why till here it's data, here onwards is captive. Okay, both together you have to take when you're calculating NCI. Thank God it's 2 company. If it was 3 company, you'd be panicking. But usually they will not give you 3 companies like this. 3 subsidiaries they will not give you, right? Never. It's always 1 or 2, or 1 subsidiary, 1 associate, or it's like that only, or both are subsidiaries, but not more than 2 they will not give you, so you don't have to worry about it. NCI in captive. Okay, now we are finding at accusation. Okay, at the date of accusation, what is NCI? Already is given to you. We have calculated this from working 3. It's not given. Fair value is not given. Partial goodwill you have to use. We use 20% of the net asset of captive. We got 105.2. Next, post accusation net assets. Okay, what is the post accusation net asset? Here it's like this. Here net asset increases 100 and NCI was 20, so 20. Add. Here we don't have any see, here you don't have to deduct your impairment of data goodwill. Why? Because when you're using partial goodwill method, remember, you don't have to reduce the NCI part, only in the full goodwill method. Okay, this is because it was full full goodwill. That's why. Partial goodwill, no, you don't take, you don't minus it from NCI. Okay, so finally you add and you will get this figure. This will go in your consolidated statement of financial position. Okay, now let us go to the reserves. Definitely reserves will go, retained earnings. Okay, how do you take the retained earnings? Start with the parent always. Okay, parents retained earnings you take as it is because it will not change. Okay, so this, from the statement of financial position you will get this figure when you go to the retained earnings, 1066. This one of the traveler. This and this you cannot add as it is. There are so many adjustments which you need to do. When you are taking the other components of equity also, this 60 you can take as it is of the traveler, the parent company. Okay, because if you go to the other components of equity, see both are under reserves. That's why working 5 is known as reserves. Okay, retained earnings also comes under reserves, other components of equity also comes under reserves. Okay, so for here also if you see, it starts with traveler 60, statement of financial position only. Okay, always the starting position is statement of financial position for the parent. Next we are going to, don't jump into 2 companies together, finish 1 company at a time when you have more than 1 company to deal with. First they will finish with data, then we'll go with captive. Okay, sale of non-current asset. A non-current asset has been sold out. Remember the consideration when you got to get the captive, some amount was for cash, some amount was for that land building. That land building was how much? You have the carrying amount was 56, so that 56 needs to be deducted from retained earnings. Okay, because remember in the retained earnings we debited retained earnings by 56, because we recorded a profit of 64, but we have to credit this, so that gain comes to 8, therefore this needs to be minus. Then we come to the impairment of both will come in the retained earnings. Okay, it was done under working 6, just now we went through it. Impairment of data also, impairment of captive also, write it which company it is for with the working like this. You need to label like this. Okay, data working 6, captive working 6. Okay, for data, if you see, it's only the parent, only the total was 50, but you are only taking the parent's proportion of it, that is 80% of 50, which is 40. Okay, coming to captive, you are taking 61, here also the parent's portion. Okay, NCI portion will not come in the retained earnings, that's why you cannot take the full goodwill method. It does not matter here when you're calculating retained earnings whether it's partial goodwill or full goodwill method. Whatever it is, only the parent's portion will go. Coming to the post acquisition retained earnings, that means after acquisition the retained earnings definitely you have to add from both data and captive. Okay, so here it will be 60, here it will be 80%. Okay, 60% here it will be, not 80%. Don't take the additional 20% when you increase. Your retained earning didn't increase when you bought additional 20%. Remember that. That's why we are only taking at the initial 60%. And it, okay, so this is 143. This is the retained earnings which you need to take. And here also for captive it is 79. Okay, working 2. Let us go to working 2 to show you. Okay, it is this retained earnings, how much it has increased. You can see from here, this is 79. Okay, for captive, and here it was 143 for data. That means basically you are seeing the change from reporting date to acquisition date. Okay, the balance goes to retained earnings, how much it has increased. That is known as post acquisition retained earnings. Okay, that you need to take, but only up to the parents proportion 60 and 80% add together, so this will go in your statement of financial position. Coming to other components of equity is also same for data, for captive. For data, here also you take 60%, not the additional 20%, and this also how much it has changed from acquisition date to the reporting date. It's there in the working to same like retained earnings, so you add. And positive movement in equity, remember that positive movement in equity 8.3 needs to be added under other components of equity. Okay, so this is the total which will go. Next we have impairment of good, we already went through it. Okay, increase in shareholding we already went through it, so only we are left with property plant and equipment. We have covered all the workings. Okay, so here when you have to consolidate, remember always start with the parent. Statement of financial position is there, just take as it is. Data also take as it is, captive also take as it is, property plant and equipment from the statement of financial position. Later any changes relating to fair value, now you keep it here. So there has been increase in value of the land for data 10, right? Working 2 is there, refer to working 2. Even for captive also 22, refer to working 2. Okay, less disposal of asset, remember we have disposed an asset that needs to be deducted 56. So this is your total this thing. Okay, now we are going to make the statement of financial position. We are done with all the workings. Okay, so what else? Just fill the numbers in the appropriate places. That's it. Write a proper heading, please. You can, if you miss this, 1 mark you are losing. Consolidated statement of financial position as at which date, and make a column. Start with asset. Okay, non-current asset, property plant and equipment. Please write the working next to it when you're using working for it. Just now we have got it. So this is over. Goodwill we have calculated. Goodwill, you are taking both goodwill. Okay, if you see only one property plant and equipment, only one goodwill you are writing, not 2 3. Financial asset, it is there in the statement of financial position. No working is required. Just go back to your previous statement of financial position and keep on adding. Current asset also just adding, no changes are there. Share capital, only the share capital. What share capital are you taking? Retained earnings working 5, other components of equity working 5, NCI also working 4. Okay, share capital only parents. Okay, Only the parents' share capital. You are not adding. Don't consolidate the share capital of all the three companies. Total non-current assets, same current liabilities, all the three companies add. Okay. So hence, does it balance? That's a thing which you need to see. So what is the total asset? Total asset is this, and total equity and liabilities is also this. So it balances. It should balance. Okay. If it does not balance, then check yourself if you have the time. Otherwise, don't waste your time to correct the statement of financial position. Just carry ahead, go ahead, okay, with whatever you have done to get the maximum marks and make sure that you finish the paper. So now we have done with it, and now let us go to second part of this. Okay, we have to read the case study. Okay, now you have to see whether they are in accordance with IFRS standards. Let us read. At the start of the year, and this is separate from that one, okay, this is not linked with first one. At the start of the year, Traveler acquired a major subsidiary. The inventory acquired in this business combination was valued at its fair value at the acquisition date in accordance with IFRS 3. Inventory increased in value as a result of fair value exercise. A significant part of the acquired inventory was sold shortly after the acquisition. So inventory was sold shortly after the acquisition. Okay. Next. In the consolidated statement of profit or loss and other components income, the directors intend to split the cost of inventories acquired in the business combination and sold by the acquired after the business combination over two different lines, cost of sales and non-recurring items within operating income. What did they do? Cost of sales and non-recurring item. Okay, they have split that. The part presented under cost of sales will correspond to the interest carrying amount in the subsidiary's financial statements, and the part to be presented as a non-recurring item to present to fair value increase recognized in business combination. The non-recurring amount to 25% of travelers earning before interest and tax. Travelers intend to disclose this accounting policy in the notes. Okay, so they want to disclose this, and to explain that showing the full fair value of the inventory within cost of sales will result in falling gross profit margin. What does they think? That if you include this in the inventory within cost of sales, it will show a result in the falling gross profit margin. Traveler argues that isolating this part of the margin in the non-recurring item, they want to show this in the non-recurring item whose nature is transparently presented in the notes. Nature is there in the notes, will enable users to evaluate the changes in the gross margin. This is a bit complicated, right? Looks like little complicated and all, where to start and all. First question we know it's consolidated statement of position, do some working and get it. But this one, how do you start? We definitely have to see the answer for it. Okay, definitely. So many standards are required. Okay, if you see this question is plenty big enough, right? You start with IS2. Okay, basically, what is the disclosure of the impact of fair value uplift? Start with IS2 because IS2 deals with inventories. Okay, if you see the answer, how the answer has been given is one standard per paragraph. IS2, first paragraph. Second paragraph talks about IFRS 3 because it's business combination. Third is IS1 because presentation matters a lot. How do you present? Okay, fourth, you are linking it to the case study. It's for 7 marks, right? So make sure that you write for 7 marks. Let us start with IS2. What does IS2 say? Okay, they told that the carrying amount of inventory sold to be recognized as an expense in the period in which the related revenue is recognized. Okay, cost of sales are costs previously included in the measurement of the inventory which has now been sold plus unallocated production overheads and abnormal amounts of production cost of inventories. So you have to recognize it as an expense. The carrying amount of the inventories sold. Next, IFRS 3 requires the acquirer to measure the identifiable assets acquired in a business combination at their fair value. When you take a subsidiary's assets or liabilities, you have to measure it at the fair value, at the date of the acquisition. Under IFRS 3, we know that. Therefore, the carrying amount of the inventory originating from the acquisition of the subsidiary is the acquisition date fair value. Okay. Consequently, the entire carrying amount of the inventory, including the effects of the fair value setup, should be presented as cost of sales. Okay. Now we are going to the IS1. Presentation of financial statements. Sets out the minimum levels of required items in financial statements. Minimum level has to be there of the required items in the financial statement by requiring certain items to be presented on the face of or the notes to financial statements and in other required disclosure, either on the face of the financial statements or as a note. So they provide little further guidance on the presentation of line items in financial statements, such as the level of detail or the number of line items that should be presented in the financial statements. The absence of specific requirement arises from the fact that the guidance in IS1 relies on a management judgment about which additional line items, headings, and subordinates. This relies on the management judgment. Okay, if you want any additional line items to be disclosed or not, it depends on the management whether they think it's good or not. So, are relevant to the understanding. They have to see whether is it relevant to the understanding of the entity's performance of performance, and also they should be presented in such a manner that you have to follow the rules of whether it should be relevant also and it should be reliably presented also. So what does IS1 says further? It allows entities to include additional line items. It does include, right? Amend descriptions and ordering of items in order to explain the elements of financial performance due to various events which will define frequency and predictability. Transactions like business combinations may have a significant impact on profit or loss, and this transaction are not necessarily frequent or regular. You see, you don't do business combinations daily. You don't buy daily business and you sell it. No, and it's not frequent. Okay, but it can have a significant impact. We know how much costly the purchase considerations are. So this can have a significant impact on profit and loss, and also it is not frequently and not regular. However, the practice of presenting non-recurring items may be interpreted as a way to present extraordinary items in the financial statement, despite the fact that extraordinary items are not allowed under IS1. So they are trying to say, the answer is trying to say is, you are presenting this as a non-recurring item. That means you are showing it as an extraordinary item. Extraordinary item are not allowed under IS1. This you should know, okay? It can also be argued that additional lines and subtotals as permitted by IS1 may add complexity to the analysis of the financial statements. Yes, by adding more lines, you might make it more complex, which may become difficult to understand. Okay, so it may become more complex, difficult to understand if subtotals and additional headings to isolate the effects of non-recurring transaction from classes of expense or income is there. Basically, you are giving a disadvantage of having it. So what should you do? To conclude, finally you have to give a conclusion. For conclusion, 1 mark is there. The cost of inventory, how should it be sold? It should be presented as cost of sales. Okay, this is the conclusion. And not split in the manner proposed by traveler. Feel free to write it, okay? If you think it's not in the manner, then you have to write it. But you have to justify it. Okay, all this was justification only they were giving to say that it should be as a cost of sales and not it should not be done in the manner which they have given. Now we'll see the marking scheme, and we have finished question number 15 successfully. Now we are just one more question away from our ethics question, which is question 16. Okay, we'll see the marking scheme, how 23 marks are given. So 2 marks for property, plant and equipment. Workings are required. 3 for goodwill. Other assets and liabilities 2 marks. Share capital 1 mark. Retained earnings 5 mark. Other components of equity 3 marks. This is all. If you see, this is your statement of financial position. If you see, okay, it is given like this only. Non-current asset. Then you start with asset. Then other asset liability. Then share capital, retained earnings, other components of equity, NCI. Basically, you have calculated wherever working is required. More marks are there. Wherever working is not required. For example, you have some other assets and liabilities. Okay, it's just 2 marks. All financial instruments, all current liabilities, everything you added, it is just from the statement of financial position you are taking. There are no additional workings for that. You will just get 1 mark for it. Property, plant and equipment has a working, so 2 marks. Goodwill has a working, 3 marks. Share capital, no working, just the parents share capital, 1 mark. Return earnings has 5 Okay, it has the biggest working. Other components of equity also 3. How 3 marks? One from the parent plus the other component equity of the data plus the other component of the captive. So for the 3 company, to get the right figure, you will get 3 marks. NCI is 4 marks. Okay. Definitely. How NCI is 4 marks and return earnings is 5 marks. We'll go through this in detail. Okay. Right now only we'll go. How this is 5 and 4. How to get those 5 and 4 marks. And for the last one, it is 1 mark per point. Okay. So you can write 7 points to get 7 marks. But this definitely will go through retained earnings and NCI, 5 and 4 marks. Okay. Let's go through NCI. NCI is working number 4. Okay. How do you get the 4 marks for NCI? Okay. 1 mark you will get for this reduction. This reduction you will get 1 mark. This is now so very annoying when this thing doesn't work. Okay, it really annoys me. Okay. So 1 mark for reduction in NCI. Okay. Wherever working is required. Okay. Another mark is where NCI percentage of post acquisition net asset. Another mark is here, 61.6. Okay. Another mark is in the captive post acquisition net assets. And another mark is for the impairment of goodwill. So impairment of goodwill is half a mark for data, half a mark for captive. Post acquisition net asset, half a mark for data, half a mark for captive. That's how you are getting 111. You see how you are getting the 4 marks? Okay. So this is how you are getting the mark. Now let us go to the reserves and see how we are getting the 5 marks. Okay. So definitely for reserves, you will be getting the marks for this you will get 1 mark for the sale. Then impairment of data, goodwill, and this you will get 1 each. Then for the post acquisition you will get 1. You see how you are getting the marks? Post acquisition return earnings for both the companies 1 mark, impairment of both the companies 1 mark, sale of the non-current asset 1 mark. For traveler, you are not getting marks because it's just like copy pasting. You're just copy pasting it. No additional working is required, so you're not getting marks. Okay. And finally, maybe the final answer is for your answer. So maybe somewhere they might give you half or 1 mark. Okay, this is just my prediction, but this is how the marks are. So this is how it is divided. Okay, and this same pattern applies to all the other questions. Okay, so with this I will be ending this question here and see you in the next question number 60. The last question finally. I know that most of you are very tired of group accounting. Like all these days I've been doing group accounting. So not anymore. Okay, I'll be doing other reporting issues and ethical issues from question 17 onwards. I don't know exactly from 17 till when I have to see it, but see you in question number 16. Till then, take care and don't forget to subscribe to my channel. I definitely want to see 1K subscriber, exiting 1K subscriber by August. Okay, because this August I'll be completing 1 year on my YouTube channel. So I want you to give me that gift of having 1K subscribers, so we'll be celebrating it. So till then, take care and see you.